Good afternoon. How are you today? Louis Yanis, WealthNet Investments. This is Market Coffee Talk. Today I'm going to review a book. I read a book from Jesse Livermore. You might have heard of it. It's How to Trade in Stocks. Jesse Livermore was a trader who was like an amazing trader who made millions of dollars many, many years ago, like in the 20s. And what is amazing about his works and about his discussion about the markets and how he traded is that what he did back then applies 100% to now and really has applied as long as I can remember. It's absolutely amazing going back and listening to and reading his works because it really shows you that nothing changes in the market. In fact, he even says that. It struck me. He said, nothing ever changes in the market. And so I wanted to review some things from his book that I thought were just, and these are things that you probably have heard of, but just getting and reviewing this. If you really want to make money in stocks and you want to trade yourself, this is a great resource and I highly recommend reading it. How to Trade in Stocks by Jesse Livermore. So I've got my notes here and I'm just going to go over some of the things that really struck me. And happy Friday, by the way. So if you're watching this today, let me know, do you trade stocks or do you invest in stocks? Let me know in the comments. And if you have any questions about this stuff, just let me know. Okay, so the first thing that Jesse Livermore says in the book is trading in stocks is like a business. And in order for you to really make money, you have to keep good records. And it's like, well, wait a minute. Okay, keeping good records, no big deal. This is so important. In order for you to actually know how to make money in stocks, you have to see how you're doing. What, are you actually making, how much are you losing when you're losing money and how often are you trading? One of the things he says is that nothing new ever happens in speculation and it's all happened before. And I'd mentioned that before. It is very true. What we're seeing right now with Bitcoin and with Dogecoin and with Ethereum, this is no different than the railroad stocks when they were taken off the radio stocks, the speculation, the exacerbated exuberance. This is really no different. It's so funny. I did a Google Trends. You can go to googletrends.com and you could see what are people searching for in various topics. And if you look at what's trending right now, it's all Dogecoin, Ethereum, Bitcoin, and you could see the peaks of when people are searching for things, and it's amazing. The market's always top when all of the public is searching for certain things. They're always getting interested in something after the fact. But one of the things he talks about is that there are times when you don't want to speculate. And he also actually makes a big distinction between investing and speculating. And his distinction is there are no distinctions. So, which is big. So Alex, hi Alex, how are you doing? Alex says, yes, keeping records is very important. It allows you to gather stats on your past trades and make better decisions in the future. Absolutely. Because depending on your style, you might find that your average winner is, I don't know, 10%, 15, 20%, 30%, whatever it is. And if you don't cut your losses correctly, you don't get that math right, like how often are you right versus how often you're wrong, then you're going to have a problem. So you have to get those reward risk ratios in line so that you're making money. So that's a good point, Alex. So one of the things he was talking about was that there are times when you don't want to speculate, right? And I was telling you about speculation being really there is no distinction between investing or speculating. It doesn't matter whether it's in real estate, it doesn't matter it's in stocks, whatever it is. All investing is a speculation. And why? Because if you look up the definition of speculation, speculation is just simply anticipating a move and anticipating what's going to happen in the future. All investors are by definition speculating because we don't know with 100% certainty what's going to happen in the future. So, when you hear people say, oh, well, I'm an investor or I'm a speculator or I'm I'm not a trader, I'm an investor. That's a bunch of bunk because if you're investing, you're making a speculation about what you think is going to happen in the future. Maybe you have a valuation model or something that you're working on that makes you kind of think, quote unquote, that you're not speculating. But when in reality, when you look at those models are built on assumptions that are speculation. I mean, if you know my background, I'm a chartered financial analyst. So we can talk about investing all day long in fundamental analysis. But in the truth, even if you're a fundamental guy, you're a speculator. So Jesse Livermore is interesting because he made so much money in the market. And if you're watching this right now, I kind of want to know, are you investing in stocks or do you trade in stocks? Let me know in the comments and anything that you're thinking about. The first point we made was that you have to have good records. Jesse Livermore talked about in his book, How to Trade Stocks. And I'm kind of reviewing his book there because I think it's just such a great starting point for people to think about. So he talks about market operations, and he says money can't be made every day in the market. So if you ever hear somebody say, all I want to do is make 1% a day, those guys are full of bunk, right? Because the market does not, you can only get what the market will give you. So, the markets will, and I don't care what kind of market it is, to be able to make 1% a day or something like that's crazy. And if you do see somebody who's doing that, there's usually one or two things that are happening. Either number one, it is a Bernie Madoff situation. Because if you looked at Bernie Madoff's equity curve, it was a straight line going up. Or it's going to be some kind of selling volatility scenario where you have a high win rate, but then when the volatility expands, you lose all your money or you lose a huge amount of money. So you're never really you never have this. I'm going to make 1% a day. Another thing he says is speculation is nothing more than anticipating coming moves, which we have already talked about. And of course, one of his points that he said is that you have to have a definite basis for your call. So no matter what it is that you're doing, you need to have a definite basis on why you're investing. So that definite basis is the key, because that definite basis needs to be based on actual numbers so that you can make money, right? It can't just be shooting from the hip. And he says, if you have, wait for the market to confirm your theory. Okay, this is a huge one. So the other day I got a phone call from a client, and a client said, hey, I've been thinking about, I don't think Tesla is going to go down anymore. It's down around 600. I think it's, you got to buy it now. And I mentioned to him, why don't you wait for it actually to bottom and stabilize and then start heading up, then place your trade. And, this is one of the things that Jesse Livermore said. And, back in the day, I used to do a lot of programming, quantitative analysis, and algorithmic trading programming. Before it was cool to be an algorithmic trader, I was actually in that business. And we actually found that if you added just a simple rule to pretty much anything, the simple rule that just said it needs to reverse and start moving in your direction by some amount, that simple rule always improved the result. Because if you just anticipate something without a confirmation, it really doesn't work as well as if you actually see the market confirming your behavior, what you're anticipating. That's a huge thing. That thing alone could help so many people do better in the markets. He says markets are never wrong. The market's never wrong. And the answer to that is, I kind of philosophically don't agree with that, because sometimes the market anticipates something that doesn't happen. But I think over the long run, one of the things that you consistently see is that the market will move in a certain direction, even though you may think it shouldn't happen. And then it winds up being later, you find out, wow, something was really happening. So listening to the market, there's like real wisdom in the market. So one of the things he also says is, don't be anxious to get in, wait for confirmation, which we talked about. And don't pick bottoms. The best stocks show a profit right from the start. Now, this is actually really true. I'll give you some evidence on that. So we did some quantitative analysis last summer, and we've done this before, but in a different way. This last summer, we did some analysis on all of the Russell 3000. So it's like 3,000 stocks. And we looked at those stocks and said, okay, if you had perfect foresight and you only made a profit in every single trade, how long did it take? How much did it go down against you before it actually went to the profit? And how much? Like, what was the drawdown in that trade? And we looked at it over various time frames. And it's amazing because the stocks that are profitable in various time frames, 20 days, 50 days, 63 days, a year, the amount of time that you're in the negative is actually a lot less than the losing trades or even all the trades. So what you really glean from that is that a stock will not move that much against you when it's a profitable trade. And I have probabilities and all that stuff. We could really get into the weeds with this, but basically a stock will not move against you very much. And the more a stock moves against you, the higher probability, that's my dog talking to me, the higher your probability that you're going to lose money. So that's why you have to cut your losses. That's so verifiably. What's amazing is they didn't have the crunching power and the quantitative power that we have today, and even though he didn't have that, he knew that from just his experience. It's really kind of cool. So don't pick bottoms. The best stocks show a profit right from the start. And as long as a stock is acting right, hold on to it and let it ride. Protect yourself if a stock doesn't rise relatively quickly. So that there's a concept of a time stop. So a time stop just basically says, look, if you enter a stock and you want to give it a certain amount of time to make money, and if it doesn't make money in that time frame, it's probably not going to be a winner. So I've done some quantitative analysis on that, and there's a lot of truth to that too. So if a stock doesn't tend to be moving in your favor over a certain amount of time, the longer that time frame, the higher the probability that the longer the time frame that you're not making money, the higher probability that you won't make money in that stock. So that's another really, it's just, like I said, it's so interesting that he had no computing power back in the 20s, yet he knew this from his experience, which is awesome. And he says profits take care of themselves and losses never do. A stock speculator must have be his own insurance broker. To protect his capital, you must have rules. So yeah, I mean, this is crazy. Being your own insurance broker is basically you need to insure yourself from losses. So there's times when you're like 100% definitely sure that something is going to work and it continues to move against you. You have to protect your capital, especially once you know your numbers, you know what your average win is. You have to have definite rules as to how you're going to get out. The other key point about this is he said, hold on to your winners as long as they're acting right. This is huge because the way a stock is acting when you're holding it will tell you whether or not you might need to start taking some profits. And I would tell you a lot of stocks have not been acting right lately. A lot of stocks are showing signs of distribution where volume is increasing and the stock is going down on higher volume, or you're not getting much price progress. Those types of things can be warning signs. Or some stocks have had these big exponential moves and really accelerate and on high volume just stall. Those are all signs that you want to be careful. So watching how a stock, you can't just sit back idle. You have to kind of watch how your positions are doing. So he talks about the time element. He's really big on the time element, which is a little bit hard to understand what he's talking about on the time element. But he's talking about how you basically he's thinking about how a stock moves over a certain amount of time and how fast it's moving. So never sell a stock because it seems too high. Never buy a stock because it's too low. That is very true too, and that goes back to the picking tops and bottoms. There's a lot of quantitative analysis on that to prove that's true. You could just look at intermediate term momentum. If you have strong intermediate term momentum, intermediate term is generally 6 months to a year. If that's above average, those stocks tend to outperform in the next months. So there is lots of evidence for that. So, and the same thing with stocks that are going down a lot, have negative momentum, they tend to underperform if that's in the intermediate term basis. So every stock is a speculation. We kind of talked about that. Never average losses. So when he's adding on, one of the things that he talks about is that only add on to a position if it's moving in your favor. And, it's very interesting because we've tested different types of entries, and that really depends on the market conditions that you have. If you have a strong market, then that tends to be true. You only want to be adding when a stock is moving in your favor, right? You don't want to be adding, if you're in a chop market, that may not necessarily be true. But that's a very interesting way to think about things. Talks about studying the character of a stock. And he goes into this big elaborate discussion about when a stock starts, when you buy a stock and it starts making a move, and if you did your timing right, you could see normal moves and abnormal moves, which is the volume and the price action. And there's a real basic rule that you could think of. It's just like, is the stock moving up on stronger volume and down on lighter volume? That's generally normal action. And if it is selling off, which you're going to normally see, you'd like to see it on lower volume. That's not always the case. We had some stocks this week that sold off on huge, heavy volume. Fluor, FLR, sold off on pretty enormous volume and had a massive day, down day. So being patient with a stock. So once you have a stock that's working, it's like you have to be patient with it and give it more room. So that is hard to do, because once a stock starts moving up, it's there's this tendency to want to get rid of it. And the idea is they will take care of yourself. They will take care of themselves, right? The profits will take care of themselves, and the losses won't. So you got to act on the losses. So he's talking about lots of different things with direction, volatility, but honor the danger signals. So the danger signals: high selling volume or a lot of volume with no further price progress. All of that, it's good. It's a good idea to honor those and to get out of those. But there's so many things in this book. If you have not read this and you are interested in stocks, another thing that's always interesting is you can always get back into a stock. There's always this feeling of regret when you get out of a stock and it continues to go higher. But if you got a stock that's got the right company's got the right characteristics, the right earnings, and all that, and if you keep them on your watch list, when they come back up and hit buy points again, you can re-enter a stock, and that's really, really cool. One of the things Jesse Livermore talked about in this book, and I'm for those of you just coming on, I'm talking about Jesse Livermore's book. His book is How to Trade Stocks, and just it's incredible. He wrote, started writing this a long time ago, like in the 20s. He talks about following the leaders, because this makes total sense. The leading stocks will be outperforming the market. When you start a new bull market, those leaders will be the first ones to start heading higher. They'll be the ones that, maybe they've been trading sideways or going down some when the market went down, but the leaders will be the first ones to start breaking out of that. And if that's what the stocks that you want to follow, and confining your focus, getting too spread out. He's really, interested in being focused, and it's better to watch your stocks closely, be more focused, and then to scale your positions in and out as the stock is giving you various signals. I need to take a drink of water. So you want to confine your focus to the leading stocks. He also talks about keeping mentally flexible. Yeah, I can't tell you how important that is, being mentally flexible, because you have this idea about what's happening, and then things will change. And if you're not paying attention and being flexible, you'll miss what's happening. So money in hand, talks about guarding money. He's a big proponent of, or he was a big proponent. He's no longer with us. He was a big proponent of, once you made a profit, let's say you started off with whatever, a certain dollar amount, and it went up, he's a big proponent of saying, okay, take half of that money that you've made and you've closed out and just bank that. Don't risk that capital. So taking money out of the market. So at some point you have to draw a line in the sand to say, what is capital that's for trading and what is profit? And you have to differentiate at some point. And then he goes through, and I kind of graphically drew this out. He goes through, some basic concepts about a pivotal point. He calls it a pivotal point. Today, most technicians will call it a pivot point. But it's basically this concept that there is a precise point where stocks tend to, if they clear a certain price level and break above that, there tends to be no more supply left, and you can make money because it's all buying interest. And that's a very interesting concept that does work. It still works today. And also, by the way, there's no perfect methodology, obviously, in investing or speculating or trading. There is just there's no perfect way, but you have to have a methodology that works over the long run. So we talked about scaling in and out, not listening to tips. Don't listen to people who are out there telling you what to buy and what to sell. It's like keep your own journal. Keep your own journal. because inside information, I can't tell you, even people that are close to situations will tell you about certain things, and then it's completely off base and doesn't work. So, you have to be careful with that. You have to be careful what do other people say. One of the things he talked about, and you have to kind of read between the lines, is about testing. He tested what's happening in the markets by placing some trades, and I do that even now today, because it's really important to see what is the market conditions really right now. If you go in and you're trying to buy a stock and you put a small order in to see, do you get filled right away, or does that order just kind of sit there and you can't buy it, or does the bid and the ask keep going up and you have to chase it up? That tells you there's no supply. That's a really strong indicator about what's happening right now in that market. So testing trades is big. I know George Soros did that quite a bit. I know a lot of good traders do that. You want to test to see what those conditions are right now when you're trying to get a trade in, and you might change your entry on how you go about it depending on what you're seeing. So, for example, if you have a situation where you put an order in and you get filled immediately and you get a better price, and you had a limit order that was, maybe you're splitting the bid and ask, or maybe you hit the bid and you put a buy order in, and you got filled even at a better price, that market is actually weaker than you think. So you want to be more careful because your timing may be amiss. But if, on the other hand, if you go in and you split the bid and ask, or you hit the bid trying to buy at the bid rather than the ask, so lower price, and the bid just goes up, and then the ask keeps going up, and you're not getting any, you have to chase it up, then you need to hit the ask and get filled, because that stock's on the move. Yesterday, I noticed that happening in some stocks where they were that was happening in the financials, because I was trying to get filled on the financials and they were not cooperating. Anyhow, so there's just a ton of great information in here. So I highly recommend it if you're a individual trader. If you are a professional in the professional money management business, like we are, like I am, it's always good to go back and watch these things. Even if you're a value investor and you have a different view of the world, this will give you an idea about how a big portion of the market participants are going to be responding to various market action, and you may have to adjust your trading for that as you're trying to implement your plan, even if you're a value investor. So anyway, that's all for now. I've gone for a little bit longer than I wanted to. Just wanted to really talk about this because it's just amazing when you have certain things never change. And I was just talking about that today, how you want to focus in on those things that don't change, because those are principles. If you have something that's going to stay now, it's going to be the same 10 years from now, 30 years from now, 50 years from now, that's a principle. And that principle you can use and have more reliability with that than versus a fad. And some of these things, and really almost all of the things in here, are not fads. They're actually principles. All right, Louis Llanes signing off. I hope you're having a great day, and we will talk to you later.